Nowadays, they actually move in straight lines for much longer than they used to. People stay on the trend until it doesn't work anymore. And that has two effects. The first one is the trends can carry on longer without pullbacks for longer than you think. But when that does turn, the moves down happen much more quickly and much more abruptly. So whereas before you might have had a steady pullback, 5 to 10%, now you might get a 20 to 25% pullback.
Welcome to our first in the series of discussions with traders. Yes, I have been looking down the client list and found some interesting stories to bring to you. Talking to people that enjoy trading but also have a day job or a night job in some instances alongside. Yes, I'll be talking to everybody who works as an acrobat to a zookeeper and everything in between. So if you've got an interesting story, then please get in touch, richard.mcdonald@ig.com. But my first of these discussions is with a good friend of mine. I thought, what better place to start than a city trader who has converted into becoming a DJ. Mark Knapp, welcome to the show.
Thank you very much, Richard.
So take me through how the transition from a hedge fund trader to becoming a DJ has been, and how long did it take?
I think like a lot of people during COVID, we all had quite a bit of time to think about our lives, what we were doing, and planning for the next few years. And during that period, I started to fall back in love with dance music again and music production. I played piano and drums since I was a kid, but having had a career in the city, there wasn't much time for that. I suddenly found myself building a little home recording studio and playing around with some tunes, and decided that after a good career in the city, I wanted to try something else with my life. And wanted to try being a professional producer of dance music.
But you didn't want to give up the trading completely, so you continued as an IG client, or you were a new client to IG?
Yeah, I've been a client of IG since about 96, 97. Dating myself here, but when I was back at university, I had a summer job selling gas door to door. It was when the utility markets were opening up, and made a bit of money out of that and invested in 4 or 5 different stocks through IG Index. And one of those at the time was Baltimore Technologies, which was a cybersecurity company.
Wow.
Actually ended up going temporarily into the FTSE 100.
I remember.
I think they went bust after that. But
that was the dot-com boom.
It was. I caught the tail end of it.
Yeah.
Can't claim to really know what was going on around that time. I think I was probably caught up with very early internet chat rooms and investment forums that were going on.
Right. So your trading career started in 96, 97. That's also where most of your tunes come from now, isn't it?
Exactly right. Can't be a bit of piano house.
So how do you divide your time now between trading and between your music production?
Yeah, good question. I think one of the hardest things about leaving the city is you're suddenly out of a routine that you've been in for over 20 years. So you're used to waking up at 5 o'clock, getting into the office, reading all the overnight news, etc. Now, I have to make my own schedule. So I do still get up and I do still read the financial news, and I do still watch the market open to see where things are trading. But after that, I'll then go about my other day job, which is DJing and music production. So in that way, the investment side of it becomes slightly more longer term than it did when I was in the city. It was perhaps more trading orientated. It needed to be. I was working for hedge funds or proprietary trading desks that demanded that kind of focus. Mm-hmm. Whereas now I'm quite happy to buy stocks that I consider to be heavily undervalued and don't have to look at where they're trading every 5 minutes. I can take a slightly longer term view.
And what instruments do you look at? Is it just stocks or some commodities and FX?
Yeah, good question again, because I think during my time in the city, I was always put into a certain area. So I was always an equities specialist within Europe. So I didn't really spend a lot of time looking at other things. But now I've been able to get more into precious metals, which has obviously been very interesting given what's been going on in that space in the last year or so. Yeah. And yeah, natural gas. Be careful with that one.
Oh, really?
But you can. It gives you a chance to explore other sectors or even countries that you might not have traded before. I did some US, but not a lot. Now I can do a lot more if I like to. So yeah, it gives you a lot more freedom from that front.
So do you think trading is a skill then, and you can adapt that to any product or any asset class? Or do you think it takes a different kind of skill, equities, to the others, such as FX?
I think you can translate it to any particular sector or country. However, what you don't have if you go into, say, trading commodities when you've been trading equities is you don't have the experience to fall back on. So quite often in equities, I'll say, for example, today in Diageo, they've got a new CEO, Dave Lewis, who's come in, who's got a fantastic track record, having turned around Tesco. He's come in and possibly kitchen sink the numbers today, a bit of a profit warning, and he's also cut the dividend for a balance sheet that's very stretched.
Tell us what you mean by kitchen sinking.
So yeah, kitchen sinking is really almost putting the worst case scenario out there at the beginning of his tenure as the new CEO. That then gives him the opportunity to go ahead and beat those low expectations and make him look like a superhero going forward. Hopefully, that's the plan.
But of course, it means renovating your house and you throw out everything. Of course, when you renovate a house, you usually keep the kitchen sink because you don't buy a new one, right? But that means you just thrown everything out there, worst case scenario. And yeah, so you think that's something that you learn in the industry and then you can identify it.
So where I was going with that is Dave Lewis has a track record, which I know because I was an investor in Tesco before. He came into Tesco and it wasn't all roses from the start. He did exactly the same thing. He did what we just described as a kitchen sinking. He then went ahead and beat for about another, 20 quarters or something.
Wow.
So having that experience and knowing the background of how he operates can give you a slight advantage. Whereas, say, if I go into commodities and there's a sudden move in silver, I might not have seen that move before, I might not have experienced. You might panic and make, the wrong decision at that time.
What do you feel are the main differences from trading in what some people would call as a retail trader? So somebody who doesn't do it professionally. What are those differences from when you used to sit in front of a screen for 12 hours a day?
Well, I don't have to field calls from 25 brokers every day. That's the main big one.
Bonus.
Exactly. But you obviously don't have the same amount of information. Simple things like the Bloomberg terminal, which is, at the forefront of information for financial services. It's very expensive. So as a retail investor, you're probably not going to subscribe to that. However, that said, there's never been a better time to be a retail investor. And you can use simple tools like AI to give you a summary of company results, give you a summary of presentations that have been made by the CEO on that day. Yeah. Years ago, you would never have had information to a conversation that an analyst had with the CEO on a conference call. That would have been very hard for you to get access to. You had analyst conference calls and then you had public conference calls, and they were usually separate. And now they're one and the same thing.
Right.
But in terms of...
It sounds like you're quite a fundamental trader rather than technical then.
Both. Right. Definitely both, yeah. I'm a value investor, contrarian investor, as you know. So I like to wait for dislocations in the market. Sometimes they can be temporary. Sometimes they can take a longer period of time to resolve themselves. And that's part of being a contrarian trader. You have to have a lot of patience. It's probably the hardest thing for someone sitting at home trading is things might not happen the way you think they might for weeks, months, and in some cases, years. So most people tend to lose patience quickly.
Mm-hmm. Or lose their nerve.
Or lose their nerve, exactly. And at the exact moment that you actually want to add to the position, they're cutting it or they've hit their stop loss. So that's something that I think you have to be very careful with in terms of stop losses. Yes, we advocate using them as a measure of protection, but if you're a contrarian investor like I am, you might find that when you're getting stopped out is the exact moment you may want to add. So,
how do you stop yourself going into panic at that moment? You could call it the eye of the storm, right? When a lot of people are getting stopped out or even margin called, how do you step back and use your experience to get you through those really tough days?
I don't think there is an easy way to get through them, is the honest answer. Won't sugarcoat that answer. I think it's not a very nice way of describing it, but when you feel pretty sick in the pit of your stomach and you're ready to throw in the towel, and so is everybody else around you that you're talking to or that you're watching, you know you're probably quite close.
And we've done it. I remember sitting watching NVIDIA when it was going up 7% a day. And I think this was the third day it had been up, between 5 and 8%. And I messaged you and said, what is going on? And we both decided we just had to go and take a walk. And I remember going out and walking around the block, and literally 20 minutes later, it dropped 10% in a straight line. And but I felt sick, and I felt, everything was telling me, the fear inside my body with my P&L, everything was telling me to cut the position. But that's what everybody else was doing, and that's the only reason it kept on going higher.
So with that in mind, going back to what you were asking me earlier about how it changes being in a retail side rather than an investment professional, on the retail side, you're not as close to everything that's going on. You're removed from it. And going back to your technicals versus fundamentals question, what the technicals tell you is what's happening in the market and what people are concerned about. So in terms of screening for stocks, I used to have brokers phoning up telling me, oh, this is oversold or this is undervalued or whatever. Now you only have to go through some charts to realize what's going on. There's a theme. People are selling software stocks. They're worried about disruption from AI. So the technicals often tell you what's happening in the market, and that can be the first port of call to then do some more in-depth research into what's going on. So you can ask AI, you can do your own research, you can see, have they just reported results or have the peer reported results? And then you can start to see, is this the start of some initial concern about, let's stick with the software companies, AI disruption? Is it the first time it's been mentioned? If it is, maybe you don't want to step in straight away. You want to see how this plays out. And you want to wait for an almost euphoric meltdown in stock price and euphoria in news flow and articles around concerns about this theme. And at that point, for me, that is when I go, right, now I know other people are panicking. I mean that in the nicest possible way. That's your entry point. And you might still be early, and you have to be prepared to still be early on that trade, but that is a good starting point. So I think I mentioned to you before we came on air that I like horse racing. I like betting, and I did it as a kid. And one of the mantras of horse racing is trying to find value bets. Right. So what I mean by that is if you have a horse that you think should be an evens favourite, so that would imply that it would have a 50% chance of winning, or it would win half of all the races run. But the market, when you go to have a bet with the bookie, it's actually, the horse is priced at 4-1. Right, which is actually implying a 20% likelihood of the horse winning. So if you keep backing those horses at 4-1 that you think should be at evens, you will have losers along the way, but over time you should make money. This goes back to your old, statistics that you might have done when you were at school. Yeah, it's very simple in that respect, and it's the same with investment and with value investment and with contrarian trading. If you do enough trades over a long period of time with good risk rewards, you will make money. The hardest part is sticking with those trades when they're not working, or maybe even not doing anything, and you get bored, you overtrade, and that's when you miss the move that you've been looking for.
I notice you interchange the words trade and invest quite often, as if they're certainly linked. But what would you understand the differences to be, and how would you describe the different mindsets that each has?
Yeah, I mean, investing is typically associated with longer term investment of money, and trading, I think some people see maybe as intraday trading or short-term trading. For me, even as a market professional, as an investment professional, I would overlay the two, and I'll tell you why. I used to work with some portfolio managers who was so convinced that stocks they had were 50% cheap to fair market value. That's fine. They'd done the work. They met the company. They were tight with the management. They would invest in the company and then they wouldn't touch the stock. So the stock would go up 20%. They pat themselves on the back. Then it would go down 10%. Then they come round to me and ask me, why has the stock come off 10%? I say, well, it's just gone up 20%. Yeah, but it's still cheap. I said, yeah, okay, that's fine. But stocks generally don't move in straight lines. So in terms of how I see the difference between investment and trading, I actually see them as working together. So you can have a core position. Let's go back to the Diageo example, that you think at £17.50 is going to be a great investment over the next 5 years.
Yeah.
But in the next week, it might have a rebound to a 10% rebound, to £20 or something. You might want to take, I don't know, a fifth of your position off there. And then if it comes back 5%, you might want to add that fifth back. And that is how you make supernormal returns over your peers over a longer period of time. A lot of people don't like doing it because they're so worried about missing out on the bigger move. But I got some advice in my very first week of being in at UBS, when I worked for UBS on the trading floor. And somebody said to me, if you sell part of your holding, you've always got room to add it back. Mm-hmm. If you don't do anything at all, you don't have any room if you're 100% invested.
Yeah.
And that advice has always stuck with me.
And what about the new investors that have come through since 2020, right? So let's say you've now been DJing for 18 months.
Yeah.
Somebody who's been learning to invest for the same amount of time, and they know what the S&P 500 is, they know what the all-world tracker is. But the stage that they've got to is like you in your early days of music production, right? They just know that if they keep buying it, then over time it goes up, right? That's what social media has told them. That's what all the statistics tell them. So all they're doing is buying, and they're 100% invested every single month. When they get their salary, they put it straight in. They've never traded. What kind of first steps would you give them to start them in that idea that you've just mentioned?
I think that question is even more valid now because of where interest rates are. Right? When interest rates were close to zero, it's a hard argument to make that you shouldn't be 100% invested in equities, right?
And why is that, just for the real basic understanding?
Because if you're sitting in cash, earning nothing, and inflation is maybe at 3%, your money's eroding at 3% a year. Nowadays, you can get probably 4% in a bank. Inflation's probably around 3%. So you're net making, 1%. It's not amazing, but it's not value destruction either.
Yep.
So what we talk about, the opportunity cost of where you put your money. So if I have my money in the stock market, where else could it be earning money, and what's the risk reward? If you're nervous about the stock markets, if you're nervous about AI disrupting workforces, you're seeing companies like Procter & Gamble laying off 8,000 workers, Unilever 6,000 workers. These are big numbers. At some point, all the rest of the companies are going to do this. Is it going to impact the job market? The answer is probably yes. And then impacts the economy and consumer demand and so on. So the stock market is not immune from those things.
Okay.
So you have to bear that in mind. So is it wrong having some of your cash in a 4% interest account? No. And then that gives you the flexibility at some point to take money back out of those savings accounts and into the stock market if it's maybe, say, 10 or 20% lower, if you feel like that's a good risk reward opportunity, as we talked about earlier.
So you think that there's the opportunity to top slice, as you might call it, and just maybe sell 20% of your position, because then that gives you the chance in the event of a sell-off, which we see generally twice a year, do you think?
Well, those events, we used to call them sort of black swan events, happen much more regularly than statistically they should. Mm-hmm. And there's lots of different reasons potentially for that, but one of the most obvious ones is the rise of algorithmic traders, trend followers. So when I first started in the city, probably 85% of money was run by people like yourself, me and you, and we were humans that were making those decisions.
Yeah.
So if a stock had run up 20%, we would say that's had a decent move. We'll take 25% of the position off, and that might keep a cap on the stock, and the stock might pull back.
Okay.
Nowadays, having said earlier that stocks don't move in straight lines, nowadays they actually move in straight lines for much longer than they used to. And that is definitely due to trading algorithms and trend followers. People stay on the trend until it doesn't work anymore. And that has two effects. The first one is the trends can carry on longer without pullbacks for longer than you think, which for a contrarian trader such as myself, you have to be really aware of.
Yeah.
But the other thing to note is when that does turn, the moves down in the stock happen much more quickly and much more abruptly. So whereas before you might have had a steady pullback, 5 to 10%, now you might get a 20 to 25% pullback. And the reason for that is that everybody now is so disciplined around their stop losses, as we talked about.
Yeah.
So if everybody who's doing trend following says, right, when the 20-day moving average passes down through the 50-day moving average, I'm going to take my profit in that long that's done so well, or I'm going to just have a flat 10% stop loss. If it's 10% off the highs, I'm just going to close my position.
Okay.
They all have the same stop loss rules. And so by definition, they're all trying to get out at the same time. And actually, the stock doesn't fall 10%. You can't get out down 10% because everyone else is doing the same thing. So you might actually get out down 15 or 20.
Right.
So for a mean reversion trader, you almost want to wait until you can see what we call some signs of exhaustion, where stocks they're not having those big lurching moves down. They've tested levels maybe 2, 3, 4 times and rejected those lower levels.
Mm-hmm.
They usually go in a sideways motion, maybe for 1 or 2 months.
Right.
And then when they start to pop their head up above the parapet and break out those sideways patterns, those are usually the times where there's excellent risk reward, because you've exhausted all the sellers. People who have had panicking and want to sell, they've had a chance to sell out.
Mm-hmm.
And people that have been short those stocks and been riding the momentum wave of being short and packed themselves on the back are suddenly thinking, hang on a second, these things are reversing, I should close them. And you can get some very large, quick moves in those scenarios.
For somebody that hasn't got the experience, because how long were you in the city?
Around just under 25 years.
Right. And which institutions did that cover?
So I did around half of that at UBS, the Swiss bank. And then I worked for Millennium.
That's the good Swiss bank, the one that still survives.
The one that's still operating, yeah. And then I worked for 2 American hedge funds, Millennium and ExodusPoint.
Amazing.
So they were what we call multi-manager models. So I was a portfolio manager that sat with a large group of other managers, and we were all managing individual portfolios, and then the risk is all summed to the top, and those funds ended up being very successful.
And how did you get into that job at UBS in the first place?
Well, I went to university, and in my first year of university, I did a summer job where I was selling gas door to door in Plymouth.
Right.
Knocking on people's doors and trying to get them to switch over to Calatex gas, which was cheaper than British gas at the time. And you got paid in cash for every person that signed up. And actually had quite a decent summer doing that. And I took that money and opened an account. I'm going to give you a nice plug for IG Index here, but I opened an account with IG Index.
Right.
And bought 4 or 5 stocks. And one of them, I think I mentioned earlier, was Baltimore Technologies. And so having had that experience of trading through university, when I went to apply for a job with UBS, which was a graduate training program, I didn't have the same school background or hadn't been to Oxford or Cambridge or anything like that. But I think they liked the fact that I had put my own money at risk. Yeah, that I was a sort of natural at trading, and I really enjoyed that side of it. And I knew that I wanted to go into trading. And quite often I found when people were coming in for job interviews when I was later in my career, they didn't really know which area of the bank they wanted to go into. No. And I think it helped at that particular time that I knew I wanted to go into trading.
And what year was that?
That was 2000.
Right. Just before the dot-com bubble burst.
Exactly. So when I came into the market, there were high quality stocks that were trading at PEs of 5, 6, 7 times earnings, which was extremely cheap because people were having to sell those to buy positions in dot-com businesses that were, I mentioned, going into the FTSE. So if you were a portfolio manager, you had to chase the actual weighting within the FTSE in those stocks and be underweight the stocks that you really should have been buying, which were the proven businesses. And it's almost quite similar to what we're seeing now. Right? You're looking at market-leading, high-quality businesses that have traded at strong multiples for years for very good reasons, that are now for the first time in years coming back to very, very attractive valuations. So the likes of Experian, Relex, market leaders in their fields that are actually already spending a lot of money on implementing AI and using it to their benefit, that have been penalized because they've been seen as, or they're in short baskets. So what happens in the city is investment banks tend to find a theme. So during COVID, it was, we've created a basket of stocks for companies that are going to benefit if we stay at home for longer, or companies that are going to benefit if we go out again. And people would trade those baskets indiscriminately. And if your company ended up being in one of those baskets, your stock would be getting sold every day, despite the fact that maybe half your business was still open, and your balance sheet was solid or whatever.
So reality doesn't really count. It's the bank's perception of what your business does. And it might look right on a spreadsheet, but they just chuck it in this basket, and then hundreds of millions of dollars chase those baskets around, don't they?
Exactly. And don't forget the kind of people that are trading these baskets. They're not all British institutions. Quite often they're American investment funds or hedge funds, and they're putting a call in. Hey man, how do I play this anti-AI theme in Europe? What are the best stocks? They say, oh, funnily enough, we've got a basket for you there.
Imagine that.
We can sell you this basket. So they don't really know what's in those baskets.
And they don't care.
So if your stock happens to be in one of those baskets, it can be quite painful.
So since you don't have that Bloomberg screen in front of you, how do you pick out the opportunities that arise from such a inefficient method of trading?
Yeah, again, as I said earlier, I think a lot of it is screening through charts and then working deeper to try and understand exactly what's behind those moves. There's so much information freely nowadays. Obviously, even on the IG website, you have news articles. You click on any stock, it will tell you, why a stock is the worst performer on the day. Not that far behind the investment professionals anymore. The only thing you really lack now as a retail investor is direct access to senior management. That's what you don't have. But everything else, reports to results, reports to conference calls, it's all there on the company's websites or in AI transcripts.
Are there any specific websites you use for news and updates?
You can use the London Stock Exchange.
Right.
They put all the RNSs on there for free. Regulatory News Service, which is the public announcements that have to be put out by companies. But then the companies' websites themselves, they cater so much to investors now. I was doing some work on Tate & Lyle yesterday, which is a bit of a fallen angel. So they're the ingredients business. And people have been selling that stock because they still sell sugar. And obviously we're all moving to healthier diets, much as yourself, Rich, in very good shape.
With that iron brew.
Exactly right. Deep fried Mars bars. So I was looking on the Tate & Lyle website, and they actually have the consensus earnings forecasts collated from about 20 different brokers on their website. So you can go on and see the same information that professional investors are seeing on their Bloomberg terminals, which is incredible. That wasn't available before. And then you can go and make your own calculations about price earnings forecasts and whether you think they're realistic or not.
Going back to the music side of it then, are there any similarities in your previous career and how you trade nowadays and the skills needed to DJ or to produce music?
Great question. And the answer is definitely yes. Yeah. Things I didn't know about DJing before I started. The equipment in nightclubs is different in each nightclub that you go into.
Right.
So I just presumed it was all the same equipment. So you have to do your proper training and try and put yourself out there and experience live DJing on different equipment, because that's when you'll make mistakes.
Yeah.
That's when you will learn. I DJed for the first time out in Ibiza last year, and I was doing a sunset mix, and I planned it meticulously. I'm quite professional in my planning. I got out there, and I didn't clock for the fact that the sunshine would still be coming into the bar I was playing at, into the Space Terrace near Cafe Del Mar, and the sunshine was on the decks, and all the decks are digital these days. I couldn't see anything.
Oh no, shocker.
But luckily I've got a good ear, so I had to use my ears to mix rather than using the sort of digital markers that you have on the DJ decks these days.
It's like when you get a fast market, and the trading systems used to just freeze, didn't they?
Yeah.
And it was knowing your positions, knowing, you know, where stocks were, getting on the phone, real sort of back to old school broking. But yeah, you had to really come up with a plan B, didn't you?
It is, and it's adapting to whatever the circumstances are there at the time. So I'm playing Ministry of Sound in 2 weeks on Friday. I'm playing the main room there, which I've not played before. And I'll have to get there and see what the previous DJs played before me, see what the crowd's like, what they're enjoying listening to, and adapt on the night. And that's the job of the DJ. And it's also the job of an investment professional, you know. You have to adapt to what the market is telling you, not put your head in the sand. Even if you disagree with it at the time, stay flexible.
Right, Mark Knapp. Well, I hope this is the first in a series of interviews with great traders. Thank you very much for coming in and being our first in the chair for these discussions with traders. And we wish you well and look forward to an update and seeing you in Ibiza.
Thank you very much, Rich. Been a pleasure.
Ow.